What if you could go back 50 years and test every popular investing strategy? Buy and hold. Market timing. Stock picking. All stocks. No stocks. A little of everything. Well, we can't time travel, but we can backtest historical data. In this video, I looked at 50 years of market data to answer one simple question: what strategy actually works best over the long term? No hype. No guessing. Just lessons the data keeps repeating. What backtesting really means. Backtesting simply means taking a strategy and seeing how it would have performed in the past. For example, if you invested every month, if you stayed invested during crashes, if you tried to time the market, the goal isn't to predict the future perfectly. It's to see which behaviors consistently win and which ones fail, because human behavior doesn't change. And markets tend to rhyme. 2. The strategies I tested. Here are the types of strategies commonly tested over long periods. Trying to jump in and out of the market. Buying only during good times. Holding cash and waiting for crashes. Picking individual winning stocks. Investing regularly into the overall market. These are the same strategies investors debate every year. So what does 50 years of data actually show? 3. The big surprise. Most strategies lose to simplicity. The data is surprisingly boring. Strategies that rely on perfect timing, predicting recessions, avoiding crashes, picking winners, almost always underperform. Even missing just a few of the market's best days dramatically reduces returns. Why? Because the market's biggest gains often happen during uncertainty, shortly after crashes, when most people are scared. Trying to be smart often means being out at the worst possible times. For the best long-term strategy, according to the data, across decades, crashes, recessions, wars, inflation, and booms, one strategy keeps winning. Consistent investing into a diversified market portfolio held for the long term. That means investing regularly, like monthly. Owning many companies, not just a few. Staying invested through downturns. Reinvesting gains. Not reacting to headlines. This strategy isn't exciting, but it compounds quietly and relentlessly. 5. Why this strategy works so well. It works because it removes the hardest parts of investing. Timing. Prediction. Emotional decisions. Instead, it relies on time in the market, economic growth, human innovation, compounding. The market rewards patience, not cleverness. And over 50 years, compounding does the heavy lifting. 6. What the data teaches about market crashes. One of the biggest fears investors have is crashes. But when you look at long-term data, every major crash eventually recovered. Long-term investors were rewarded for staying invested. Those who sold often locked in losses. Crashes feel catastrophic in the moment. In hindsight, they're often temporary interruptions. The best performing investors weren't fearless. They were committed. 7. What this means for you as an investor. The lesson from 50 years of data is simple. You don't need perfect timing, insider knowledge, constant activity. You need a simple strategy, consistent investing, patience during bad years, discipline during good years. Most people don't fail because of bad strategies. They fail because they abandon good ones too early. If there's one thing 50 years of data makes clear, it's this. The best long-term strategy isn't exciting, it's reliable. Boring beats brilliant. Consistency beats prediction. And patience beats panic. If this video helped you, consider liking and subscribing. And remember, the market doesn't reward speed. It rewards staying power.